Hey, so in this video, we're going to go in depth to learn about the stock market, how you can get started, some of the different strategies and tips that some of the best investors in the world use to make money in the stock market. So hopefully this is going to be a comprehensive, all-inclusive little guide to help you start investing. I know there can be a lot of questions out there and a lot of confusion when first starting with investing. How do you get started? How much money do you need to start? And various other questions that people might have. So maybe take out a pen, piece of paper, and consider sitting down and following along here in this video. I hope we can provide some value to you. That's why we create these videos, to help people make more money, save more money, and build a better financial future for themselves. I'm not sure why schools don't really teach these different subjects, but hopefully you can find some value in this video. So if you do, make sure you subscribe to the channel, and let's just get started with this. Now, the one problem that kind of arises is that a lot of people have financial advisors that they're paying them large fees to manage their money. But, you know, a lot of people can actually do this themselves. And that's the truth behind this. I have a lot of friends who are financial advisors, great people, and there's nothing wrong with using a financial advisor, but they can charge large fees, 1% or more sometimes, which can really add up to thousands of dollars down the drain to pay people to have them invest for you. So you can actually do a lot of this yourself. That's what this video is for the people who are go-getters, who want to start to learn how to invest for themselves without the assistance of maybe a financial advisor or somebody else. So we're going to start off right now. One of the first things that you need to do before you actually start investing, and this is incredibly important that you do this. I know you might be eager to start investing, but the one thing you have to do is do a full audit on your current financial situation. This is so incredibly important. Look, if you want to start investing, but you have $45,000 worth of credit card bills, unpaid credit card bills that are high interest debts of 20, 25% or more, you want to consider paying those off before you start investing, because it's important to be realistic as to how much money you can make in the stock market, especially as a beginner. Now, look, there are ways and there are stories of people who are making, you know, thousands of dollars in their first couple of days investing into the markets. It's possible. You hear those stories about penny stocks. You hear those stories about people who became a millionaire in a couple of weeks in the stock market. That's all very possible, but being realistic, or at least using statistics, the stock market grows anywhere between 7 and 10% per year. Now, you can beat the market. People like Warren Buffett started off in Nebraska with very little money and now is one of the richest people in the world. He has almost $100 billion to his name. That's a lot of money, and he started with literally nothing. So anybody can do this, and you can beat the market. I'm going to give you some different tips and tricks and strategies that Warren Buffett has used to make billions of dollars. Now, once you do that full audit on your finances, understanding that maybe, okay, you don't have too much debt, you don't have high interest debt, then maybe you could consider start investing into the markets. If you find yourself in that position, what I would suggest doing is start to set some money aside for these investments. And look, you can start with any amount of money to start investing. You don't need to have $50,000. You don't need to have $100,000 to start investing. You can start making money in the stock market with literally $5, even $1 in some cases. We're going to talk about some different stockbrokers that you can use further on in this video as well. So there's really 3 different types of strategies for investing, and we're going to go as much in detail as we can for this video about each strategy, and then you can pick one that maybe you want to focus on or learn more about. And I'm going to leave some books down below, some different links to different books down below. I think it's one of the best ways to start learning about investing. This is just one video. I can't share everything that there is to know about investing in the stock market, but I can give you a nice overview as well as some of the best books to get started. So I'm going to leave maybe 5 or 6 different books down below that I think could really provide a lot of value for you. So let's talk about the first strategy for investing. And this is what I would consider to be probably used by, I would say, 80% of investors in the stock market world, right? So it's known as fundamental analysis. This is what Warren Buffett uses. This is what Charlie Munger uses. This is what Bill Ackman uses to make money. This is where you see a lot of billionaires being made by doing something called fundamental analysis. Now, the strategy behind this is you're essentially trying to find the value of a company and then looking at the stock price and seeing whether or not it's overvalued or undervalued. Obviously, you want to buy a stock that is undervalued. So if you can calculate all these numbers and say, you know what, I believe this stock should be worth $80 per share, but it's only showing $60 per share, then maybe that's something you would consider buying. Now, if you're not familiar with what a stock actually is, the best way to understand this is that it's a piece of a company. It's a parcel or a little fragment of a company that you can own. You own one share, or you can buy 100 shares or 1,000 shares, however many shares that your heart desires, you can buy of that company. And there's a certain amount of shares of that company. So you can buy little pieces of a company. If I buy PayPal stock for $110, that doesn't mean that PayPal is, the company itself is worth $110. It means that you can buy a small piece of that company, less than 0.01%, very small percent of that company for $110. So that is the going rate at the moment, and it can fluctuate throughout the day and throughout the week. That price can go up or down, right? So you want to buy those ones that you believe are going to go up. And a lot of that is common sense, but if you have more questions about it, let me know down below, or I would suggest just checking out a page like Investopedia, looking up different things about stocks and kind of getting a better understanding will hopefully help you out. But for those of you who do understand the basics of what a stock actually is, understanding that it is just a piece of a company that you can own, then you will be set for the rest of this video. So fundamental analysis, the way that we're doing this is we're using different financial ratios and different key metrics that we can analyze the company with. So I'm going to give you some homework here that you're going to want to do after this video to fully be able to understand how to value this company. So there's three big different financial statements that you're going to want to look at for this company. And all the public companies that are on the stock market have to release their financial statements. So we're looking at income statements, balance sheets, and cash flow statements primarily are going to be the ones that you're going to want to really look into to see where this company stands. Now, if you've never seen these statements before, it might just look like a bunch of mumbo jumbo gibberish, right? You're going to see numbers everywhere. You're going to look at a balance sheet and say, what are assets, liabilities? How can I make sense of this? Well, we can make sense of them by doing our homework on them, but also by understanding ways to calculate different ratios, financial ratios, to then understand whether or not a company could be undervalued or overvalued. So I'm going to give you a couple of different ratios here that I want you to look into on your own. For the sake of this video, we can't make it too long of a video, but I want you to write these down or keep these in your head and start to look into them a little bit more after this video. One of them would be something like the PE ratio, right? So the PE ratio, price to earnings ratio, this is really important to look at, but if I told you something right now, if I said that a PE ratio of 15 is good, that would totally mess people up because it's not necessarily good. It could be good in some situations, but you have to understand the context behind it. So that's why I can't give you too much information on that, if that's making sense, because I don't want to confuse anybody. And there's not one specific number where you can look at a ratio and say that's absolutely good in every case. You have to understand the full, broad, big picture of this investment and these different metrics. So the price to earnings ratio is important to look at, right? Another one is earnings per share. How much money is this bringing in per share? So EPS is another one that you want to consider looking at, as well as maybe some liquidity ratios. You can look at the current ratio or do an acid test on some of these different companies, a quick ratio as well. You can think about the debt to equity ratio, or maybe some different financial metrics as well that I'll throw up here, that you want to start to understand how to calculate these ratios and what they could imply or mean about this particular company. If this company has way more liabilities than it has assets, that could be an issue, but it's not always an issue. To give you an example here, you look at something like Tesla, right? You think about all the Tesla cars that are coming out, but Tesla is losing money. I believe they just posted about $700 billion in total loss, or sorry, $700 million in total loss from just this past quarter. So because of that, if you look at those fundamentals, you say, wow, Tesla is not a good company to invest into. They're losing a ton of money. Amazon's not even making a ton of money either, but you want to look at the other aspects of that company as well. So that is what can be a little bit confusing. That's why we can't go into it too much as to what these metrics mean. But trust me, do your homework on these, and you're going to start to feel more confident about your ability to find good companies and bad companies, ones that are overvalued and undervalued. And it's going to give you a nice little base to this. Now, like I said earlier, I suggest picking up some different investing books. One of the best books to start with fundamental analysis. This is probably my favorite investing book of all time, and I believe it's been argued that it is the best investing book of all time. It's known as The Intelligent Investor. So this is written by Benjamin Graham. He was the mentor to Warren Buffett. And if you can pick up this book and actually get through it, I think you're going to find so much value in it. The very first chapter of it talks about the difference between investing and speculating, and why it's so important to invest and to minimize risk while increasing potential reward versus increasing risk but also increasing potential reward can kind of create some problems in the future. So that's our entire goal of this, to minimize risk and increase reward. That's what investing is all about. You don't want to find yourself gambling. I would really not consider buying a company on a whim, saying I have this gut feeling that this company is going to do good or it's going to do well. I would personally avoid that. You want to think about how to use logic and math and statistics to determine whether or not a company will go up in the long term or whether it's going to go down. So fundamental analysis, the entire point behind this is almost always going to be long-term investing. And this can seem boring, especially for people who are antsy. You want to get started investing, you want to make $1 million by next week. Everybody wants to do it, but if you want to get one of the most surefire ways to invest and make money over time and build wealth over time, I would consider looking at fundamental analysis. So let's talk about the other two very quickly, very briefly, that are used less often, but can still be very, very effective ways of making money in the stock market. And especially if you can use all three of these in conjunction with themselves, that's when I've seen a lot of people really do well with this. So the next one, I would argue, is used maybe by about 10 to 20% of investors, probably closer to 10% of investors, and that is known as technical analysis. Now, technical analysis, what I would suggest doing is just picking up a book called Technical Analysis for Dummies. I read this a long time ago, and it gave me a nice little base of understanding the basics of it. But this is for people who are generally looking for shorter term trades. So swing trading or day trading, people who are trying to get in and out and buy based off of charts, in many cases, based off of charts and different metrics that they can see changes in those metrics and assume that there's a higher probability that X is going to happen because Y just happened. So they're analyzing more so statistics and charts instead of the actual core company and looking at the financial statements of that company. That's the best way to kind of explain that, the easiest way to explain that, and it can be very effective for people. I know people who are doing quite well by using technical analysis. Now, I believe in some cases, if you're attempting to do trading penny stocks or day trading quite often, I personally don't do this. I don't think it's a bad thing to do. I know people who do it and make a lot of money off of it, but the reason why I don't choose to use technical analysis as much for things like day trading is because it can be a little bit more labor intensive, if you would, to say that that you would be having to spend more time kind of analyzing these different companies and analyzing these different metrics and numbers and charts versus fundamental analysis, where you can just kind of read about that company and then maybe take a week off or a year off and come back and know that that company's probably still doing well. So technical analysis can be a great strategy. I think it's great to use it in conjunction with fundamental analysis. If you can read books on both of these and combine them, I think you could be set up for success, or at least understand how both of them work before you choose which route you want to take. Now, there's a third strategy for investing that isn't used really primarily solely alone, but it can be used in some cases, and that's by analyzing the psychology of investors. So using some behavioral analysis to decide whether or not you should buy or sell a stock. So there's this really famous quote by Warren Buffett that you want to be fearful when others are greedy and greedy when others are fearful. So really what this behavioral analysis will do is you want to kind of analyze how people think and then find ways to exploit that or make money off of that. If everybody starts freaking out and selling, maybe that's a time to buy, or vice versa. So that's one that I can't touch on too much, but there are some books out there for some different psychological effects and reactions that people have to the markets. People are very emotional creatures, and because of that, there are times when you can actually make money off of kind of understanding human psychology and the way that people react. So just one that I thought would be important to touch on ever so briefly. So for this video, we'll assume that you may want to take the route that 80% of investors in the past have taken, which is really focusing on fundamental analysis. So once you fully understand how to use these different financial ratios and key metrics that you want to understand, like that you'll see on the income statement and the balance sheet and the cash flow statements, and how to calculate those and how to understand them, once you get a nice grasp on those, then you want to think about which companies you should start analyzing, which companies should you start looking at, and how do you go about that. So one of the best ways to do this, from my personal experience, I'm not a financial advisor. I just enjoy sharing these different ideas on this channel and on the internet. I don't know why schools don't teach this. It's really sad that they don't teach it. But one of the best ways, in my opinion, to get started with this, to find companies to start investing in, is to find a company that you are already familiar with, something that maybe you use on a daily basis. Maybe you work for this company. That can be an option to start analyzing that company, right? And you're not always going to find winners, especially in a market like we're in today, where the markets have been rising for quite some time. So because of that, it's more difficult to find a great deal, but it's not impossible. There's still companies that are undervalued in any given market. Even if we're at the highest point possible, there's going to be companies that are undervalued at the moment. It might be few and far between, but they're still there and you can still find them. So what I would suggest doing is finding a company that you're already familiar with. One of my first investments, the very first investment that I made, was in Cedar Fair. This is a company that runs amusement parks throughout the United States. The reason why I got into this was because I had a couple of family members who worked there. I understood the company culture, and I was very informed on how this company was running, who their CEO was, and the executives of this company had a good understanding of everything that was going on within this company, as well as I was an avid user of their product. I was going to their amusement park on almost a monthly basis for many years. So I had a great understanding of how this company was working. And I think that's a downside that people face if they don't know that company. For example, if I considered investing into a company out in Arizona, but I've never been to Arizona and I don't understand the company culture, I've never spoken with the employees, I find that to be a downside. If you can find something that you already understand pretty well, that can give you that little bit of an upper edge. There's a great book about this written by Peter Lynch. He was a hedge fund manager back in the 80s and 90s. It's called One Up on Wall Street, I believe. And this is a great book I would consider getting started with if you want to start finding companies that you can start investing into. So I'll leave a link for his book down below. It's a great little beginner book, not too difficult to read for beginners, but still packed with value in it. But find a company that you're using on an everyday basis. Maybe that's Coca-Cola, maybe that's Pepsi, maybe it's Google or Apple or Amazon, but they're everywhere. There's literally thousands of companies out there that you can just start running these different ratios on and start looking at their financial statements and trying to figure out whether or not this company is overvalued or undervalued. Now, if you're thinking about how to get started with this, which type of stockbroker do you use? How do you go through the actual process of doing it? It's not terribly difficult. I personally use Robinhood to buy and sell stocks on really easily to do this. There's no transaction cost. There's no fees involved. It's totally free to use. If you're confused about why it's free to use, I wouldn't be too worried. You can look that up. I believe they have a blog post on it as well as why it's free to use. But they make money in various ways off of the money that you are using in your account. So Robinhood or M1 Finance, great things to start with that I believe can help people get started with a very small amount of money. So if you find value in this video, drop a like on the channel. I would really appreciate it. I create these videos to help people hopefully start to learn about investing. And I wish we could go more in depth on this in this video, but for the sake of time, we're gonna have to cut it short. But I want you to do that homework. Start learning about those financial ratios and pick up a few different investing books. It's going to provide so much value for you. And if not now, maybe you think maybe you don't want to start investing for a little while. It's still great to build that base of knowledge on investing and the mindset of investing so that you will be successful in the future. I promise you, if you read 5 different investing books, you will be so much better off than people who do not. People who do not take action will not succeed nearly as often as people who are taking action and actively being persistent in trying to achieve their goals of financial freedom. So thanks for watching the video, and I'll see everybody next time.